whether today's announcements from the Fed and the White House and the trading activity we're seeing so far suggests a bottoming out of this horrible sell-off that we've had.
Too soon to tell that. You really need to see other factors come in, like especially a flattening in the infection curve, principally that. You also need to see the risk premiums on stocks get to a point where people start to actually buy for more than one day in a row. We're not quite there yet, and we just need more information on how the virus will spread across the United States. So still too soon to check on that.
And Paul, when you talk about flattening the curve, you're saying we need a diminishing in the number of new coronavirus cases that the U.S. announces every day, right?
Yes, exactly.
Okay. Sri, let me bring you in. I have to give you a major kudos. I have to bow to Sri-Kumar in this one, because when you said the 10-year was going to 1% and below, it seemed crazy, and here we are, and that now we're struggling to get back above. What happens with the 10-year now, and what's been the impact of all of these incredible moves by the Fed lately?
Good to be with you, Kelly. And to begin with, the 10-year yield, I see this going all the way down to zero. And the question is, when does it happen? And why does it happen? My expectation is that while the measures announced today by the Federal Reserve to support the commercial paper market and by the President and Secretary Mnuchin in terms of supporting the economy are long overdue. It is much better that it happened today than not happen at all. But that is not going to prevent a recession. I've been looking for a recession to begin mid-year, even before the coronavirus issues came about. And I've said that on your program, Kelly. As a result of the most recent developments, my expectation is that we already are in a recession. And that is not yet discounted in equity prices or in the bond yields. And those are the reasons why I think the correction in equities are going to continue and the bond yields are going to keep going down.
Okay.
As far as the Federal Reserve is concerned.
Before you go down that path, let me just ask you, look, the market's basically down 30% peak to trough, and the 10-year bottomed out at 35 basis points, and you're still saying a recession isn't yet priced in?
That is correct. I think the recession is not yet priced in. Let's look at why I'm saying that. Dr. Fauci, whom I listen to very closely, said that there is going to be this acceleration of the spread of the crisis, the coronavirus, for the next 3 weeks or so. So let's assume for a second that it crests in the next 3 to 4 weeks. Then you have an increase, but at a diminishing rate. In other words, what called the second derivative is negative. That means this thing goes on for a few more weeks. And that, in turn, brings more of the economy, more shops, more airlines, everything to a halt.
Okay.
And that is not priced in. And that is why I think equities will go down further, as also bond yields, Kelly.
Paul, do you want to venture out into that territory as well? I mean, what is different living through this experience is to see the market and the economy both declining together at the same time. You know, in other words, it's not that anticipatory feel that we had going into the financial crisis. This one, Paul, it feels as though, you know, the declines are happening simultaneously, and perhaps that's why they're sharper on the equity side.
Well, it's pretty clear how the disease progressed in China and then more recently in South Korea, and we think that investors are pricing that, and they're seeing it happen in Europe, which is now the epicenter of the disease. And we're seeing that pricing in of exactly that sort of increasing rate of infection and then a flattening out in the rate of infection. We think the market's pricing that in, and we think the markets are correctly anticipating that will have negative economic impact. And we do believe there will be a very high likelihood of a recession at mid-year, but we don't think it's going to be on the order of what we saw in 2008. You have the banking system in much better shape, household finances in much better shape.
So it's more
but it will be a sharp decline in the middle of the year.
Do you think it's priced in at these levels, Paul?
We think the market is in a position now because of what they've seen, investors in China, South Korea, and Europe. We do think investors are in a position to price that in, at least mostly there.
Final question to you, Sri. I'll let you respond to that, and also make the point about the Fed you were going to make a moment ago.
The point about the Fed is that they have come out in terms of support of the commercial paper market, which is, I think, very good, very positive. But on the other hand, they wasted a lot of bullets in terms of cutting interest rates first by 50 basis points and then again by another 100 basis points that absolutely achieved nothing. So what needs to be done is a more focused approach in terms of what gets done, Kelly, and in terms of supporting where it goes. The last point I would make is the Fed is repeating the problems of 2008. We cut the bank interest income to zero for the retired people and the low-income groups who do not participate in the equity market. That, in turn, curbed consumption spending, and we are repeating that same process again.
So you'd have them do all the emergency measures but leave rates at 1 or 2%.
Exactly. That doesn't matter. So let the retired person, let the wage earner get his or her interest income at a decent level, rather than that's already gone down to zero.
Okay. We're going to have more of this discussion with a couple more guests this hour.